Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend, Michael Fairborn, 20-plus year veteran of the financial markets. He is there to help answer your questions. Speaking of questions, the question is, what is the market going to do, especially the futures market, in response to a little bit more tariff uncertainty than perhaps traders were expecting? We'll see how that plays itself out here this morning as we get into this discussion. But welcome to all of you. Thank you for joining me, and thank you for being here, whether you're here in the live version or the recorded version. We appreciate you being here. And again, participate in the conversation. Chat in your questions there. Michael's going to help out with that. Leave your comments if you are watching this in the recorded version. We will get to those quickly as well. A couple of quick reminders, though, and housekeeping items we need to take care of. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to trading futures products. Remember that the futures trading requires separate trading authorization. It is not, again, suitable for and available to all clients. Now, when we talk about trading futures, one of the other things that we need to make sure of is that we're aware of the fact that things like virtual currency futures have additional risks. Make sure that you're aware of those additional risks. Make sure you read the NFA investor advisory on futures on virtual currencies and the CFTC customer advisory. Likewise, understanding the risk of virtual currency trading if we happen to talk about those along the way. Remember that everything we talk about is simply for illustrative and educational purposes only. It's not any kind of a recommendation or personalized advice. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. Remember that the paper money version is a great learning environment. It is not a guarantee of future success out there in the real world. And there are some things that the paper money version does that a live trading account won't do, and vice versa. So be aware of some of those differences. I'll point those out along the way. We're going to use a lot of technical analysis in this discussion, but remember, the technical analysis is not the only means of analyzing markets. There are others. They are all theoretical in nature. None of those are guaranteed as to time or accuracy or any kind of predictive ability. So therefore, Schwab doesn't recommend the use of technical analysis as the sole means of investment research. Remember that investing involves risk, including more than in futures products, sometimes your initial investment. One other thing to think about, and we'll talk about this as along the way, stop orders that generate market orders are not guaranteed in execution. They will be worked due to exchange rules. They will be substituted by an exchange-designated limit order that would be worked within a certain protection range, or what's sometimes referred to as protection points. So be aware of that. We'll talk about that as we get into the discussion. Just recognize that there are some differences in the way that stops on futures work versus stops on equities, something to pay attention to as we get into this discussion. And let's jump over here to the Thinkorswim desktop software platform really quickly and take a look at what's going on here this morning. I wanted to get this trade discussion right off the bat here, and as we normally kind of see these things moving early, one of the things that's been moving early is RBOB gasoline, gasoline futures making a big run. So what I have in this particular grid, for those of you that have been here in this webcast before, you know that this is my futures movers grid. And on the left-hand side, on this side of the chart, I have a one-year daily chart just kind of zoomed down. I've got a CCI, Commodity Channel Index, which is kind of a trend pressure gauge. And then on the right-hand side of the chart, I've got candlesticks that are 5-minute candles, just looking at today's movement. And I've got the MACD, the Moving Average Convergence Divergence, which lags a little bit, as all oscillating indicators do, but it gives us a good indication of sentiment, if you will, as far as, and momentum as far as what's going on. So here we have RBOB gasoline. And you can see that this morning, as the market has been coming to the cash open, we're a little bit beyond that. We heard the opening bells. We see this rally up strongly, a little bit of a pullback into a support level, and now starting to rally up again. And I'm going to draw a line of support here on the 5-day, 5-minute chart, kind of right under that 2.166. That's going to be kind of our potential breakdown level in terms of a support level, if we're looking at this from a technical analysis perspective, where we're looking potentially for this trade to move to in this particular case in the short term would be up to this 2.1752 level or beyond. And if we look at the longer term chart, that beyond here in this particular case is up around that 2.24 mark. Now, really quickly before we enter this trade example and kind of put this on, I want to open up this left-hand chart because I've got this informational box, this text box that is scripted, and I've put that script in the description for this webcast if you want it. But it breaks down, and you can see this information as well other places, including if you drop down and go to the futures subtab here on the symbol entry box. But you can see the tick size, so what matters in terms of the increment of movement, and that tick value, and then that point value. So think about this. If we look at this number, 2.1702, if we look at that compared to this tick size number, you can see where the 1 is. So what that means is this digit right here, and let me just grab my magic marker to point this out. For those of you who are brand new, this might be something that you are not aware of. For those of you that have been with me for a while or have been trading futures for a while, this is something that I'm sure that you have had some experience with. But it's the increment of that particular digit and the tick size of 1. So that means if this moves from a 1 to a 2 or a 2 to a 3, then that tick value is adding to the value of this contract $4.20. Or if it goes down, that's adding taking away $4.20. So that gets us to our point value. So if we get a move in points of this number right here, if that moves from a 2 to a 3, that represents $42,000 of movement in the value of that particular contract. And so what that then says is our notional value of the contract is this number right here times this point value gets us to this notional value. That's kind of the work through of what this means. Now, what that also means is we can calculate our potential gain or loss in the trade if we do this. Let me clear this out, all right? If we look at the number of ticks that we've gained or lost times that tick value, that's going to tell us our dollar gain or loss in our contract. And so that's going to give us kind of that understanding of the movement of this value, right? All right, so let's take a look here really quickly. Let's go back and let's restore our sell size and take a look at the trade as we might be putting it on here in this particular example. And this is technical and technically driven based on the fact that we're getting this little bit of a bull flag type of pullback and then rally. Not a recommendation by any means, simply looking at what is currently moving as an example here. So this bull flag, we get a rally up, a little bit of a pullback, and then a pull back down. It's starting to still make this move higher. So what I'm going to use is perhaps this level right here. I'm just going to draw a line in right here at this 2.171 level. And to me, from a technical analysis perspective and looking at these recent candles to kind of make a decision in terms of movement one direction or the other, because this is kind of still waffling in this range, what I'm going to look at is taking the trade if this moves above, if price moves above this particular level here, this 2.1711. And then what we're looking for here is a move higher. Now, there's a couple of ways that we could look at this. We could look at taking the trade off if it moves up here to this 2.175, or we could look at taking that trade and adding to that position if it does move above that level and continues to do so with some momentum. So we're going to keep that as not putting on a take profit order yet. We're going to put an alert there, and then we can make the decision based on what momentum is doing as to whether or not we add to the position or we take the trade off if it's losing momentum. The other side of the coin is once we get into the trade, we have to determine a point at which we would like to potentially get out of the trade. And it's good to have that decision making out of the way prior to putting the trade on, simply so that you have that understanding of where am I going to get out if it goes up, where am I going to get out if it goes down. So we're going to look at this level of support here at the 2.165, 2.166 level, right in that area as a potential exit. So what I'm going to do is I'm going to right click here, and we're going to create an order that is a buy custom with stop, not a buy custom with OCO bracket, although we could do that. But remember, we said we're going to just put an alert up here if it goes up and it goes out of our range. So this is going to be a buy stop. If we were to put it in a limit order right now, and it's currently trading at 2.1685, that order is going to fill. So we're going to make this a buy stop, and it says stop, wait, don't do anything until price exceeds the level at which we want to get into the trade, which we said was 2.1711. We're going to make that 2.1711, and we're going to make that a buy stop. Now, a buy stop that generates a market order. This is one of those circumstances that I remember that I said that I was going to discuss with you. That's going to issue then a limit order designated by the exchange and worked within a range of what they call protection points, right? So within and typically that's 1 to 5% of that entry price, right? Of the market price. So that gives us a range. It creates a kind of a limit order, if you will. Now, we could specify this as a buy stop limit, and we could specify a limit at which we no longer want to get filled in the trade. Outside that range, we don't want to get filled. And we could certainly do that, but just know that if you enter this as a market order or a stop market order, in this particular case, it's going to get worked as that exchange worked limit order. And that's, again, for the protection of being filled at an adverse price, because in a fast-moving market, right, in a fast-moving market, that is, in fact, something that can happen. You can get a market that moves very, very quickly, and the exchange, then would have to deal with that fill that might be significantly different than what was intended in the trade. We're going to leave that as a day order. And a couple of things, a couple of questions. Yeah, a lot of bounces in RBOB. Yeah, you're right, Mike. All right, now we're going to put our stop in here, and this is going to be relatively tight. We're going to put it at 2.1666. So we're going to come back down in here. We're going to say 2.1666. 2.1666 as our stop. And again, this is going to get worked as an exchange designated limit order. If that level gets filled, I'm going to make that GTC so that I don't have to recreate that. And then we'll come back and we'll make that alert on the chart so that we can see what we're going to do if this goes in the direction that we want it to move. Now, what we can do is we can come over here to our calculator, and we can come in here and we can say, all right, if we scoot that over here, let's do this. And I've already got it up here in terms of the formula, 2.1711 minus 2.1666, if we were to get filled at that level, is 45 ticks. Now, we know that each tick is worth $4.20. So 45 ticks times $4.20 says that theoretically, 45 ticks times $4.20 means that our risk in this trade theoretically is around $189 if this were to move to the downside and take us out of the trade once we entered the trade. Now, what that doesn't necessarily take into account is where that order actually gets filled. That's at the trigger price, right? So if we get filled at or near that trigger, that order is going to be, that's why I say theoretical. That's where that risk is going to be. If it moves down more, right, in that particular case, that's where that loss may be more given, but within that protection range that order gets worked. So let's go ahead and put this order on because we're sitting down on this level right here. It's kind of coming back down. Momentum is still higher though. Look at where momentum is relative to where it was before. The MACD is still a little bit higher. That's still the bull case here for this potential bounce to the upside. But we're still looking for a conditional order basically that says buy stop if this gets up above the resistance level. So I'm going to go ahead and I'm going to confirm and send that order. We're going to read through our initial margin in this particular trade, right? And again, remember we've got initial margin and maintenance margin. But our initial margin in this trade, which we can find in that futures drop down, is $6,356, which is going to have to be put up to be able to initiate this trade. And then you've got those transaction costs associated with this trade. I'm going to go ahead and I'm going to put this in our futures group. We're going to go ahead, we're going to click on send, and we're going to fire that order off. Now we're starting to get that little bit of a bounce, and that's why I said that momentum may be part of the key here in terms of seeing this possible bounce to the upside. Now what we need to do is make a decision. So what we're going to do is we're going to right click at that resistance level, and I'm going to create an alert that says, let me know if price goes to or above 2.1752. Then we've got a decision to make. Do we take the trade off and capture the potential gains in the trade, or do we let that trade run, or do we add to this particular position? So Siri, we've got some great webcasts to talk about that. We've also got some great videos, and I'm going to show you some of those resources here in just a second. So I'm going to go ahead and I'm going to create that order. There we're starting to see that move happen, and that order just filled. Boy, it's nice when that actually works out, because usually what happens is when I put in an order like that and I've talked through it a lot, it ends up going the other direction. Now we'll see if that continues. There's no guarantee that that order will continue in that direction, but that's what we obviously in this particular case, from a technical analysis perspective, have kind of put together here in this space. So what I want to do really quickly, by the way, I'm going to just give you a quick reminder. Click on that subscribe button down at the bottom of the page. That's going to connect you to the Trader Talks webcast channel. It's going to allow you to set alerts for new content, things like that. And it's at no cost to you. So it's a great subscription to stay connected to the Trader Talks webcasts community, if you will. So what I'm going to do is I'm going to pop over here to the Schwab.com website. All right, so this is Schwab.com. I'm out of Thinkorswim, the Thinkorswim platform at the moment. So I'm on Schwab.com, and I went to the trade tab in this Schwab.com login. And on the trade tab, I selected futures. And in futures, then I went to market overview. Because one of the things that might be part of a daily routine, I know it is for me, probably for Michael as well, is to kind of take a look at across a broad variety of futures markets to see what is going on. That can kind of give us a sense of what's happening on the day. And so in this market overview page, there's a heat map. Now, you could do this. You could create a futures symbol watch list in the Thinkorswim platform, and then you could use the Visualize tab under the Market Watch tab to do a heat map. But this one's already here. This one's already built, and you can kind of see the movement. So you've got some information here, right? You've got the specifications about the account, the percentage move, and you've got this little red or green or gray bar to the left-hand side, right? Okay. And as you start to look at this, you start to see, again, this is one of the reasons why I started looking at RBOB gasoline this morning in terms of this move, was I saw this green bar. If I look over here on the right, I'm also seeing Nikkei futures and Nikkei US dollar currency pair futures moving higher as well. And I'm sorry, that's not the currency pair. That is the Nikkei index in US dollars. This is the Nikkei index in Japanese yen. But you can kind of start to see this across the board. Interest rates, so the 2-year note kind of neutral, The 5-year note moving down a little bit. The 10-year note a little bit green. You can kind of see just a little bit of a green aura there. Palladium futures up a little bit. Copper futures down somewhat. Gold futures down a little bit. And you can see that color intensity is determined by the percentage move. Live cattle futures moving higher. Really, the only thing on the board besides the Nikkei that was moving higher here is RBOB gasoline, right? The equity futures, so the ES kind of neutral at the moment, 0.03% to the upside. NASDAQ, 0.1% to the upside. The Dow, just 0.08 to the downside. The Russell, plus 0.58, so that's a little bit stronger movement than the others, starting to turn a little bit green here as well. But there are also some other conversations here that are available. So to go back to the question that Siri asked, one of the things that you can do is you can come right over here to the Learn tab. And on the Learn tab, if you want to kind of go back to kind of that basics of understanding how futures work, we do have a bunch of webcast archives about that, but there's some content here that's worthwhile. If you go to the Learn tab and then you go over to the left-hand side and you choose Futures, there are a number of different modalities of education, right? So articles about futures content, videos, short videos, and webcasts that talk about futures. So this is me talking about futures movers. This is James Boyd talking about movement in futures. There's even a course that talks about the fundamentals of futures trading that also includes futures options. So there is some additional information there that might be helpful for you in terms of learning more about that. So Happy Camper asks a great question. So let's do this. Let's go back over to the Thinkorswim desktop software platform, the paper money version of which, and says, if gas futures, RBOB, is going up, does that mean that oil stocks might be going up as well? Let's take a look really quickly here. So let's pop back out. Let's just zoom out on that chart. Let's take a look really quickly. Now, it's kind of sometimes a bit of a conundrum or a bit of a paradox that oil stocks and gasoline stocks don't move, or at least oil prices and gasoline prices don't move in lockstep with one another, even though, let's do MCL, even though your local gas station would have you believe, or your local gasoline distributor would have you believe that that is the case, it's not necessarily, right? Because there are input costs, there are output costs, there are refineries, there are impacts to regional gasoline prices. So it doesn't always work directly that way, that you have gasoline demand and that necessitates crude oil inputs going higher. You see some echoes, right? We see some echoes here, certainly in crude oil, but crude oil currently sitting right around the $67 mark within this range, and really kind of fairly neutral here at this particular point. Not seeing much of a break to the upside. If we zoom in a little bit, you can kind of see that same type of pullback pattern here, but this does tend to stay sticky right around these areas. 67 to 68 right now is just about the lifting cost of crude oil in West Texas Intermediate crude, the cost to get the oil out of the ground. So if that's the case, that tends to be kind of a sticky level. If this starts to move higher, then that represents profits for those oil companies, those exploration and production companies. The other side of that coin is the refinery standpoint, that crack spread between crude inputs and refinery outputs, the refined products, heating oil, RBOB gasoline, other distillates, light distillates, kerosene, and others, and gasification, that kind of stuff, can be a bit different. So let's take a look at /HO. This is heating oil, and we've talked a little bit about this in terms of what this means. This maybe is a bit more, this is the proxy for diesel. So if we're seeing kind of that disparity, a little bit of a disparity between heating oil as the proxy for diesel and RBOB as the gasoline futures, this may have indicated that there was a stronger demand as we go into the summer and summertime flying and summertime driving, that there was maybe a stronger push into diesel fuel. But notice this is a little bit weaker pattern in the near term in heating oil in terms of that downside movement, right? So this is kind of that kind of cross-market analysis that we can do. And then we talked a little bit about the crack spread. I wanted to just do this really quickly. I happen to have a crack spread built for crude oil and heating oil, and I'll share this grid as well. But this grid is kind of interesting. This represents the relationship between the input cost of crude oil into the refineries and the output prices of their refined products. In this specific case, this is specifically the relationship of that heating oil, diesel, jet fuel relationship to input costs in gasoline, and it's converted. So what I've done is taken the the number of contracts in heating oil and compared that, created an apples to apples comparison to a contract of crude oil. So crude oil, 42,000 barrels, taking 42 times the heating oil contract gets you to an equivalent number of barrels. So that's where, knowing some of these contract specifications, right? Knowing what those contract specs are. And by the way, you see some of those echoes, $4.2 or $4.20 per tick, getting to that price in heating oil or RBOB gasoline, same thing, 42 gallons to a barrel of heating oil, or 42 gallons to a barrel of gasoline, gets you to that equivalent in terms of the crude oil contract. So what this line tells us in this relationship, so this is 42 times a heating oil contract minus one crude oil contract, gets us to that relationship. When this line is moving higher, that tells us that the profit margin for the refineries is increasing. When this line is moving lower, it's harder for the refineries to make money because crude oil is increasing in price and heating oil is decreasing in price. Now we have heating oil increasing in price, crude oil has been decreasing in price. That suggests that margins are getting better for refineries. So let's think about what could be done then in terms of knowing this information. Could you buy refinery stocks, equities, based on a rising crack spread? That might be one thing that would go into their impact of, their revenue stream. So this is, futures can be used in a variety of different ways, including this way in understanding that relationship. So we've diverged a little bit here, but I think that's an interesting comparison. Let me do this. I'm going to quickly share this grid. This is my heating oil, crude oil crack spread. And I'll go ahead and I'll put this down here in the grid. And remember that when we share items like this, like charts or grids or watch lists or anything else, number one, they are not guaranteed. They're illustrative and educational examples. They're not guaranteed as to time or accuracy. So be aware of that. It's simply a shared item. I will also put that, if I haven't already, down in the description for the webcast. All right, let's go back over here to the monitor tab and let's see what's going on. We've got a couple of positions here that maybe we need to take a look at. The first of which is this VIX contract, which has kind of been going against us. And we put this on a couple of weeks ago. We're getting down to the bitter end towards that end of this active contract and switching over. But the VIX has gone from the 20 range down to the 18 range. Yep, and there's our alert that just popped up for that RBOB gasoline contract. Before we get into the VIX, let's take a look really quickly here. And let's pop back over to our futures movers grid. And let's go back to /RB and see what kind of momentum we have. Momentum is gaining a little bit here. The price has kind of bounced. It's popped up through that level and it's bounced, but momentum is gaining. So my thought is maybe rather than perhaps adding to this position at this particular point, let's do two things. Let's move our stop up to our entry point. Number one, we're reducing risk. We're taking that up to that potential break even. And let's just leave this on and let this continue to potentially move higher without at least setting that take profit. But what we're going to do is we're going to set a new alert up here at this 2.41 range. So I'm going to right click, create alert. We'll create a single alert up here at 2.2411, and we'll set that alert to let us know at or above that particular level. We'll go ahead and create that alert. Now we've got that new alert higher. Now what we're going to do is we're going to adjust our stop. So we're going to go back in here to the monitor tab. Here's my stop order. I'm going to right click and we're going to cancel and replace that order. And we know that our entry point into this trade was 2.1711. And so we're going to adjust our stop to that level here. We're going to click on confirm and send. We're going to make sure that this is still good till canceled. We're going to put it in the same place back in that futures group. All we're doing is we're doing an adjustment to the stop. We're moving the stop up. Now you could absolutely, Martin, do a trailing stop in this particular case. And a trailing stop would work fine. The one caution with trailing stops, as always, and I've mentioned this before, the one caution with a trailing stop, and it looks like it took us out because it popped back down, which is fine. That's okay. That's why we put that stop in there. But the one caution with the trailing stop is that it ignores levels of support and resistance. So be aware of that. But I'm okay with that. We took a little bit of a move to the upside here. We got out of the trade, and that worked somewhat in our favor. But we've got a couple of other contracts. Here's our VIX contract that we were talking about. So let's pop over here to the chart. Let's take a look at /VX. That's our VIX position. And we can see that VIX is still continuing to move lower with a little bit stronger downside momentum. Now it's summertime. We do have some tariff uncertainty, but a long VIX trade here at this particular point, we go back to that monitor tab, that long VIX position, maybe not the best thing to do in terms of keeping that trade on, and there might be a better entry point into that trade. So I'm going to go ahead and I'm going to take this trade off. So we're just going to do this. I'm going to create a closing order, and we're going to sell that contract. We're going to put that order in, confirm and send, read through the order, make sure that we're aware of that transaction cost here, and we're going to go ahead and fire that order off, and we'll exit that VIX position. We'll look potentially for a new entry into that if the VIX does start to rise. Now let's go back to our monitor tab. We've cleared that one up. We have this longer term hold on the silver, the 1,000-ounce silver contract. So let's do this. Let's go back to our chart, but I'm going to do a different chart here. We're going to look at our single grid here, and we're going to look at our longer term position, which is /SILQ25. So we're going to bring up SIL. So we'll go to the chart, /SIL. We'll take a look at this trade, right? And I'm kind of seeing this bouncing. We're seeing the ADX falling off, so the trend strength is weakening. The RSI is diverging a little bit bearishly as this price is kind of coasting into this resistance level. So we got into this trade as kind of a longer term perspective, not a shorter term quick scalp on the trade. And this is starting to move down a little bit. So what I'm going to do is I'm going to take this one off. We're going to unwind this one that has done some work for us. And in this particular case, and again, remember, these are illustrative and educational purposes only, right? Right? And we're going to right click and we're going to take this trade off and create a closing order. So we'll just sell that position. So reading through that order, making sure that we're aware of those transaction costs, and we're going to click on send. Now, James makes a good point here. James says, well, wait a second, caveat emptor. This is for entertainment purposes only. You can't beat pro commodity traders. And I don't know that I accept necessarily the premise of the comment, given the fact that we're not necessarily trying to beat pro commodity traders. We're not trying to predict what they're doing. We're not trying to, trade opposite to them or contrarian to them necessarily. Because when you're talking about pro commodity traders, and I'm making air quotes there, you think about what their purposes are, right? Their purposes are the same as ours, right? Speculate or hedge in terms of using futures contracts. And so that's kind of the same perspective that we have, right? Speculating or hedging. So are we trying to beat them? I don't know, right? Are we trying to or outperform what they're doing? Not necessarily, right? We're trying to perhaps maybe replicate, but technical analysis is technical analysis. And trading, trading in the direction of the trend is trading in the direction of the trend. So seeing trends, whether it's a futures contract or an equities contract or the movement of an underlying position against, an index option or something like that, is simply that, right? It's simply using what we know, technical analysis, to make decisions. We're not trying to second guess or contrary or scalp necessarily or hedge or do whatever against those, right? So, yeah, I mean, so are there risks associated with trading futures? 100%. We know that. We talked about that. That's the reason why we talked about it at the very beginning. But once you understand the product and you understand the characteristics of the product and the margin requirements, then that leverage can be used to your advantage, just like it can work against you, just like in any product, right? So, but there is the potential for substantial loss in trading futures products. So we want to be aware of that. So James, I appreciate you helping us to understand that that context of the risk in the product. So let's do this. We've got one other position. I'm going to come over here to the monitor tab, and that's this position right here. And that is this /M2K position. We are short one contract of the Russell 2000 micro futures, right? And we use that to offset some of the exposure to the Russell 2000 in this stock portfolio, simulated stock portfolio. So if we come over here to this chart, /M2K, this has still been rising, and we're still starting to see an ADX that's rising, the RSI still moving higher, a little bit of a bounce here. So it might be time to take, and we talked about this when we put this trade on, that there are times to hedge and there are times to uncover the hedge, and times certainly also to augment potentially upside movement. So maybe we increase our exposure to the Russell 2000 here by removing this hedge. It's got 73 days to go. It's working for us. We're starting to see that little bit of a pullback today, but at the same time, overall, it has cost us a little bit. But remember, that is the nature of hedging. Hedging sometimes creates a cost. So that is something that we need to pay attention to here. So we're going to go ahead and take this trade off, that M2K trade, in this particular case, and we're going to unhedge or uncover, basically, unhinder this stock portfolio. What that's going to do is it's going to add about 5 M2K deltas to this portfolio, because we're going to take off those deltas. We're going to flatten this position. A couple of different ways that we can do this, but we're just going to come back here on the monitor tab, right click, and create a closing order, and we're going to buy one contract to flatten this position, not buying to open a new long position, but we're just going to flatten this position as it sits. Confirm and send, read through the order, make sure that we're aware of the transaction costs and where that's going. Click on send, fire that order off. We bought that back. Now we take a look at our portfolio and we see that our deltas have increased by about 5 deltas in terms of this in terms of this exposure. Now, we could hedge this portfolio. We could beta weight this portfolio to another futures contract, but we beta weighted it to the Russell because that's where most of our exposure is in terms of those small caps. So it's done what we expected it to do. So one other position that I want to look at potentially before we go here, we've got just a couple of moments before we go, is I wanted to take a look really quickly at that Nikkei futures contract that we were seeing moving on the heat map. So let's come over here to the NKD/NKD and starting to see that move very similarly to the Russell 2000, seeing that little bit of a bounce. So I'm going to put this /NKD in our futures movers grid /NKD. And you can still see that that is moving higher. We might look at taking this on that bounce. Contract specs, however, tick size is 5. So it's going to be this number, and that moves in increments of 5. So the next one is going to be incrementing this to a 6, and that's going to be a 0. Each tick moves is worth $25. The point value in this case, in terms of each one of those moves, equals the tick size. So if this moves, that's now added $5 to the value of this contract. That gets us to our notional value of this contract. And if we click right here, that gets us to our initial margin. Fairly steep initial margin in this particular trade. So if a portfolio size doesn't have that capital to accomplish a trade like this, this maybe is something that is outside the realm of some traders. This is a big contract, right? We're starting to see that move to the upside here. So what we're going to do is look at going long this NKD contract. And so we're going to come in here and right click, and we're going to create a buy custom with stop. And we're going to make that just a limit order. We're going to get into the trade here, but we're going to stop it if it breaks below this horizontal support at the 39925. So we're going to make that 39925. That's going to be our stop, and we're going to make that good till canceled. And 39970 to 39925 really quickly here. 70 minus 25 is 45 ticks. 45 ticks times 5 is $225 is what we're risking in this particular trade, theoretically. So that's an easy, quick calculation to do. We're going to go ahead and put that order in. Click on confirm and send. And we'll put that in our margin account, make sure that we're aware of the transaction costs. We'll go ahead and fire that order off. And we got into the trade at 39970. That's a nice round number in this particular case. And that helps us to understand where our potential risk is in this trade. My thanks, of course, today to Michael Fairborn for helping out. If you want to learn more, great place to go is to the Trader Talks webcast page and type in the word futures. My thanks to Michael also for helping out and teaching this class when I'm not available to do so. By the way, I'm going to be in Santa Clara, California this weekend, teaching a technical analysis and option strategies workshop. If you're already enrolled for that, great. We'd love to see you there. If not, it is full. But we are going to be in New York City on the 8th and 9th of August doing the same thing. So if you want to join us there, here's where you find that calendar at schwab.com/coaching. My thanks to Michael Fairborn. My thanks to our great production staff, Gabe and Andrew, for helping out here today, and our great reviewers, Nikki and Mindy, and everybody else that helps to bring these webcasts to you. And thanks to all of you. We will see you again very soon. Take care, everybody. Bye-bye.